Hi, I'm Keith Schaefer, owner of the Oil and Gas Investments Bulletin, an independent newsletter that I've been writing for 7 years on junior energy stocks. And for the first time in a couple of years now, it's time once again to invest in junior producers. The oil price is moving up now. It's come up from $26 a barrel to $46 a barrel, and looks like it could be headed higher. So for the first time in 2 years, some of these junior producers are actually making enough money where they can grow within cash flow. So I think it's a good idea right now to revisit what's the most important thing to look for in these junior producers to consider them as an investment. So I'm going to give you a couple ideas here, and really one term that I think will encapsulate all the different economics and make it very, very simple for investors to decipher who they should research further. And I'll also give you a couple ideas on terms that really, in my mind, don't mean very much that some management teams use to bamboozle investors. But just before we get into that, I would like to say that there's only a few parts of the cycle, the oil and gas cycle, where junior producers really make sense, and that's when oil prices are rising. When oil prices are falling, it's time to go to other sectors, subsectors of the energy patch, like refineries for when oil prices are declining. Or right now, a lot of the innovation in the global energy markets is actually happening in the power sector, where the smart grid in the Western world is making huge advances in what's possible and the types of communication and power savings that can be made. But right now, we're moving back to the junior producers. In the spring of 2016, oil prices are rising. So what's the number one thing that I'm looking for in investment in a junior producer? And that term would be called payback. So for example, if a well costs $1 million, I want to know how fast that well's production, whatever oil and gas is flowing out of it, will get $1 million back for that producer, so they can recycle that money and put it into the next well. So this is usually given in months. So a well might give payback of 12 months. And really that's the big number that I'm looking for. I want to see a well pay back its cost in 12 months or less. Now, when oil prices are still this low, in the mid-40s, I might go out as high as 15 months. But if a well does not pay back its cost in 15 months, my interest in this company falls dramatically. For the juniors who are cash strapped to begin with, don't have a lot of capital, they need to recycle that money quickly. So it's very important. For the majors and even the intermediates, that term payback isn't quite as important, but for the juniors, the low price juniors that can provide so much capital gains so quickly for investors, that's the number one factor that I'm looking for. I want to see the main play of that company, the growth driver, have paybacks of less than 15 months and ideally less than 12 months. So over the course of 3 years, the math is pretty simple. If you can pay back a well in 12 months, you get to drill 3 wells over 3 years with that money. But if your well only pays back in 24 months, which is most of the time now for most junior producers, that's only 1.5 wells. So you're obviously getting twice the production over a longer period of time. So payback is very important. It kind of encapsulates all the other factors of the cost of the well, the NPV of the well, the IRR of the well. That brings up another good point. Payback is mostly a term used in Canada. So both the producers and investors are used to that term and ask for it regularly. In America, not so much. So my experience is the number one term in the States to ask management teams is what's the IRR on the well? And the magic number there for me is 75%. I want to see the IRR on the wells of the main play of a producer be 75% or greater. Generally speaking, a 75% IRR does equate to roughly a 1-year payback. And so we see a lot of wells being drilled right now, both in oil and gas, that are only 30% IRRs or even less, which if you're a major and you have many thousands of wells, you can do that, but not if you're a junior. So that separates the wheat from the chaff in the field very, very quickly. So a couple other terms that I think really are red herrings for investors that they shouldn't even worry about are things like netbacks. That's the industry term for profit per barrel. When I hear a company crow about their high netback, that generally means to me they're probably hiding the fact they've got a lot of debt. It's not such an important term, and if you're being reduced to using that, generally speaking, that's a red flag for me, and I'm going to go search your financials very closely to see what you're hiding. So Overall, I think it's the time again to be investing in junior producers. The number one term that I'm looking for is payback, and I explained to you why that's important. Generally speaking, companies don't put that number in press releases or in their financials. You have to ask them. Almost all the management teams, certainly in Canada, will have that number at the tip of their tongue. And in the States, the IRR number is always going to be in the PowerPoint or the financials. So I hope you've learned something today. I'm Keith Schaefer, owner of the Oil and Gas Investments Bulletin.